Good morning. My name is Yihuan, and from Fudan University. Today, it's a great honor for me to chair the first Innovation, Productivity, and Challenge in Digital Age and Beyond the webinar seasons. It's now our first webinar season of 2022, and we have great honor to have Yao Zheng to present his amazing paper about the fintech lending and cashless payments. And Yao currently is assistant professor of finance at the Wharton School at UPenn. And previously, he did a PhD at Harvard, and then he did his master from Peking University. And also, we have now fantastic discussant, Tiffany Chai, assistant professor at NUS, and previously she did her PhD at UC Berkeley. And Yao, it's your turn for 25 minutes, and Tiffany have 25 minutes for discussions. And we're looking forward to these amazing papers. Thank you very much. Yao, it's your turn.
Very good. Thank you. Thank you again. So today we're going to talk about fintech lending and cashless payments. This is joint work with Pulak, GHOSH, and Boris, VALLEE. All right, let me set up the stage by telling you what do I mean by fintech lending. In this paper, we call a lending model fintech-based if it relies on electronic technologies and particularly alternative data beyond the usual credit scores to screen loans without developing relationships or taking deposits from their borrowers. And this is the key difference from fintech lending, between fintech lending and traditional bank lending. And when we look at the number, we know that fintech lending has been growing super fast, and it has penetrated in both consumer and small business lending. Global volume of newly extended fintech credits has almost doubled every year in the past 10 years. And this is all amazing. But it's also economically surprising because this happened in spite of the well-known informational advantage of incumbent banks. There are already a lot of big banks out there. So the question is, how has fintech lending managed to level the playing field with traditional banks, and what are the implications for the future of banking? Those are broad questions we aim to address in this paper. Okay, let me cut to the chase. The story we're going to propose in this paper is that despite the advantage of traditional banks in providing inside information in terms of engaging in relationship building, repeated lending, or taking deposits from their borrowers, fintech lenders are typically more able to use the so-called alternative data beyond credit scores, which include like internet activities, social media, geolocation, and they're able to use such information from the outside of the lending relationship to better screen loans. And in this paper, we're going to focus on presumably the most important type of outside verifiable information, that's payment. And that's like, what do you buy? What do you sell? What's your consumption? What's your production? It's important because it's directly related to a borrower's creditworthiness, and it's typically hard to manipulate. So the story we're gonna propose here, and we're gonna show evidence that the use of verifiable cashless payments by borrowers are gonna allow fintech lenders to better screen loans, and that's gonna lead to better capital allocation. That's the first key message of our paper. But that's not the end of the story. We're going to argue that there's another economic force going on, which is when fintech lenders screen borrowers using verifiable outside cashless payments, there is a strategic consideration among borrowers, which will eventually push more and more borrowers to use cashless payments in the first place. So you may find this to be a little bit involved, but again, this is quite intuitive. It's just a simple argument of if everyone in this room is using iPhone, you may be more tempted to use iPhone as well because you don't want to look like a lemon. And that's reminiscent of the traditional unraveling argument in the information disclosure context. And that's indeed the key, which eventually drives more and more borrowers to use cashless payments. So taken together, those two economic forces jointly imply a synergy between fintech lending and cashless payments, and that provide us with a plausible explanation for the joint rise of fintech lending and cashless payments in the past decade. Okay, what we can bring to the table today is a theory to formulate the idea I just talked about, and we're going to bring the model to data. We're going to use novel application data in India with payment records of many different types to identify the informational effects of cashless payments on lending. We show that the use of more verifiable cashless payments is going to lead to higher loan approval, lower interest rate, and higher loan amount, all are indicative of better lending outcomes. We're able to gain identification using a unique instrument in the Indian context, which is enabled by our data, and we're able to design targeted tests showing that effects are more pronounced for higher quality borrowers, and the effects are also externally valid to other types of alternative data. Okay, let me first talk about the model. I'm going to show you the minimal version of our model. It's simple, but it's going to generate quite some interesting testable hypotheses which can eventually bring to data. In the model, there is a competitive risk-averse financier, which you can think of as a small fintech lender, and there is a firm as a borrower, which is privately informed about its true type. You can think of that as the quality, the credit quality of that firm. The financier only has a prior about the true type Z, and there is a conditional mean mu and a precision tau Z here. Now, the timeline is discrete with two stages. From T0 to Tn, we call that production stage, during which the firm is still well-funded. It uses its own endowment to produce. There's no need for financing. But during the last period, we call that lending stage. The firm is running out of endowment. It has to turn to the financier for finance. So at every time t, the firm is going to produce the product of uncertain value yt, which is a noisy signal of the true type z. Now, an important decision facing the firm at the beginning is to choose a payment method to process all the transactions during that production stage. And as a benchmark, we think about two choices, cash versus cashless payments. Cash means that everything will be lost. Nobody will know what ever happened. Your production outcome will become non-verifiable and non-transferable. Versus cashless payments, again, it's a benchmark, so there's no adoption cost. But if you use cashless payments, that's going to help you create a verifiable payment record every period. And there is XT here, which is another noisy signal about your production outcome. So eventually, we call that the payment record. The borrower, the firm, is going to submit that payment record to the lender at the lending stage as a commitment. So at the financing stage, the firm will effectively sell the product of an uncertain value to the competitive financier, getting a price. Because of this simple Cara normal framework, we know that the price can be expressed by the conditional mean minus the conditional variance weighted by risk aversion. So that's the key equilibrium outcome we are looking at, because in this simple framework, this price can be easily mapped to the likelihood of getting a loan, interest rate, and loan amount. And particularly if you can sell your product at a higher price, it means that you're more likely to get finance, you're going to enjoy a lower interest rate, and you are more likely to get a larger loan. So let's look at that in equilibrium. We're going to first talk about the first direction of the synergy, which is how the use of cashless payments can facilitate lending. Proposition 1 says that if every firm type uses cashless payments, the financing price P can be expressed in those three terms. It's quite intuitive. The first two terms are essentially a weighted average between the unconditional mean and the true type Z. So we call this second term the information revealing effect. It's very intuitively a signaling channel, which means that those firms, they can use cashless payments to better signal their type. As you can see, if they have more cashless payments or the cashless payments technology is more verifiable, they're going to enjoy a higher information revealing effect. They're going to signal their type more precisely to the lender. And then we have the third term, which we call a risk-reducing effect. Again, it's quite intuitive because the fintech lender is still small. It's subject to financing constraints, which make it effectively risk-averse. So it has to bear some risk in this lending process, and it asks for a discount. Now, if the borrower uses more cashless payments or payments of better verifiability, that's going to effectively reduce the risk that the lender has to bear. That will be translated into a lower discount. And finally, that will be translated into a better financing term.
Yeah,
so,
clarification,
yes.
may I?
Yes,
how
please.
The cash payment, is it observable, or you assume that we know the parameters?
We know the parameters, yes. The lender knows all the parameters.
But we only know the parameters. We don't really know we have no observation.
Maybe let me quickly clarify. So here, if you use cash, so nobody will never know. Nobody will ever know anything because cash is non-verifiable, it's non-transferable. But if you use cash payments like internet payment or mobile payment, so you will have this signal.
Right.
And you can show this signal, right? You show your record to your future lender, and the lender will know that.
Right. That one is. But if I choose to use cash,
yes,
I must have confused. I am confused about your the slide forward. Your tau S. You know, in your signal extraction model. Yeah, in that slide, I'm confused.
If you just use cash, I mean, nobody would know, will never know anything. But here I'm looking at an equilibrium in which everybody uses cash as payments. So nobody actually uses cash. Yeah. I'm talking about an equilibrium in which every borrower is using internet payments. Everybody is using mobile payments. Later on, exactly, this is a good question because later on I'm going to show you why this could be an equilibrium, why nobody uses cash in this equilibrium. So that goes back to, I mean, the second direction of the synergy I mentioned earlier, and I will make sure to talk about that. But you're right.
So if everyone use no cash, cashless, you can do this thing. But if there is a mix of
we can still do that.
You still can do that.
We can still do that. So it will be a more complicated formula here, but we can still do that. Yeah, intuition will all go through. Yeah, this is a benchmark result, but it does apply to more complicated cases. Very good. So this is the first direction of the synergy. We have this nice closed form solution. And because of that, we can generate testable hypothesis 1, 2, 3. With payment records of higher verifiability, a firm is more likely to get a loan, to enjoying a lower interest rate, and get a larger loan amount. And this is all coming from the risk-reducing effect I just talked about. And this is positive for all firm types, whether they are good or bad. They can, on average, enjoy a better financing term. And then hypothesis 2 says for better firms, they're more able to enjoy the benefit from cash payments because of this information revealing effect. Again, information revealing means that they are more able to signal their better type to the lender. So that's how they can get a even better financing term. And finally, payment records of higher verifiability is going to lead to less default because, again, risk reducing effect that allows the lender to bear less risk in equilibrium. Okay, so this is about the first direction of the synergy. I'm going to talk about the second direction, going back to Bernard's question, why everybody in this simple model adopts cashless payments in the end. Let's suppose only better firms adopt cashless payments. We argue that this is not an equilibrium because the lender is smart. The lender will update her belief by viewing those non-adopters as lemons. So the lender now knows that for those people who don't adopt, they are actually worse. So they will only get this lower expected price. But that's going to make those types in between nervous. They're going to switch, they're going to change their mind, switch from cash to cashless. And that means that we're going to have.
So sorry, I have to interrupt you again. Sorry about that. I anticipate this line coming. But my question is, suppose I'm a small merchant I don't want people to know how much I make. I use cash to avoid paying tax. So that may your line may not hold. I'm just finding my profits.
Yeah. There are a lot of reasons. I mean, why in reality adopting cashless payments may be costly, right? As you said, so there could be tax reasons, there could be simply privacy reasons, right? So simply if we want avoid people knowing what happens. You're fully right. Here, I'm just showing you a benchmark case in which there's no net cost of adopting. In reality, when you take account all the net benefits and costs, so it may well be that the cost is small and that falls into our benchmark model. But even if there is a huge cost, still this idea applies because that means that still better types, right? They're going to enjoy the higher benefit from adopting. So those guys will always adopt. It may stop at some point here, but as long as some high type firms adopt cashless payments, our earlier argument will all go through. It just means that we will have a messier expression here, but it won't affect the economic intuition here. But I'm fully with you, Bernard. So here the key point here is that there is an unraveling argument here, and that's going to push more and more borrowers to adopt cashless payments. In the end, if there's no cost, everybody will adopt. But even if there is some cost, still some better firms they will adopt. And that means that in the long run, we expect more and more people to adopt cashless payments when the cost of adoption is becoming lower and lower for different reasons. Okay, very good. Now taken together, those propositions imply a synergy between lending and cashless payments. And as I said, the second one, so really speaks to the long-run adoption of cashless payments. For that reason, we're going to focus on testing proposition one, how the use of cashless payments is going to improve lending outcomes. All right, I'm going to very briefly talk about the data. We get data from Indify, one of the top 3 Indian fintech lenders focusing on small business loans. We get data about all loan applications, including eventually approved loans and all rejections across 4 years. That allows us to talk about both the intensive margin and the extensive margin of lending outcomes. We have all the standard variables, loan amount, interest rate, default status, and firm characteristics. And importantly, we're able to observe the payment records in the last 6 months prior to application. And that's important because that allows us to really look at what happened in terms of their consumption and their production. So with that information, we use text analysis on the transaction label to classify payment types. And that's important because that allows us to distinguish between different payment technologies. We talk about difference between cash and verifiable cashless payments. Here we label cash by looking at direct cash deposits or withdrawals. And for variable cashless payments, that includes certified checks, instant payments, mobile payments, and POS machine transfers. And most importantly, we are able to further classify cash payments into information-intensive ones, which means that we can exactly identify the recipients. That's like where the money goes and where the money comes from. And we can identify the amount at every transaction level. So there is much richer information when you think about information-intensive payment versus information light, for which we cannot identify the recipients or we cannot identify the amount at the transaction level. They're kind of aggregated at the daily level. I'm going to show you that economically, that's going to make a big difference. Okay, let me show you the baseline results. Remember, hypothesis one, more payments of higher verifiability, that's going to generate a better financing terms. Here, we're showing that a higher share of cashless payments is associated with a higher likelihood of getting a loan, a lower interest rate, and a larger loan amount. So that means on both the intensive margin and the extensive margin, using cashless payments is going to help those borrowers. And as I said, it's not just about cash versus cashless. It's really about how verifiable those payment data are. So here I'm showing that the economic magnitude is really driven by the use of information-intensive payments, but not by the information-light payments. Again, so that says, at the end of the day, what we really have to care about is how verifiable those data are. And something interesting I want to talk about is it's even broader than that. It's not just about payment. We can also look at the share of revenue from online marketplaces. That's like Alibaba, that's like Amazon. Obviously, in India, they have different marketplaces, but those data are also verifiable. Here, on top of all the controls and the share of cashless payments, we show that the share of revenues from online marketplaces is also positively associated with both the extensive margin and the intensive margin of better lending outcomes. Again, that says that economically, when you have verifiable outside data to show to your lender, it's going to make your life easier. So that's the key message we want to convey. Let me quickly talk about the causal evidence here. We're not saying that we want to completely ruling out reverse causality because of this two-way feedback effect, the synergy we highlight, but still we want to gain causality because that's going to help us mitigate measurement errors. To do that, we use Indian demonetization in 2016 as a shock to the use of cash. And most importantly, we'll look at the cross-section difference between different borrowers banking at different bank branches to generate a plausible exogenous shock to cashless share. So let me talk about the idea. We're essentially comparing two otherwise identical borrowers, A and B, in which borrower A banks with a currency chess bank branch. So in India, that's a bank branch which distributes new banknotes and coins. And that means that during any event of cash shortage, borrower A compared to borrower B will be more likely to get cash from the Reserve Bank of India due to its proximity to the currency chess bank. So this is going to act as a plausibly exogenous shock to the use of cash by borrower A. Or in other words, borrower A is less likely to use cash as payments. Obviously, we have to think about the exclusion restrictions, and we think that's valid because demonetization is largely unexpected and it's not affecting credits beyond the usual channel of cash shortage, and the matching between firms and chess bank branches are generally a signal to unobservable firm quality, as we checked in the paper. Okay, let me show the results. The first stage shows that borrower banking at the chess bank branch due to its proximity to cash is negatively associated with share of cashless payments. Those borrowers are less likely to use cashless payments. And we show that this only happens after the demonetization. So this serves as a natural placebo test because before the demonetization, there's essentially no effect. And then in the second stage, we use the instrumented share of cashless payments to predict approved loans. And we show that indeed, a higher share of cashless payments can lead to a better lending outcome. And this result has a causal implication. Okay, let me quickly talk about the last two results about information revealing effect, how the results of using cashless payments is stronger for better firms. We use two proxies. Number one, credit score to proxy for firm quality, and this is very intuitive. And the interaction term here shows that for better firm types, they're more able to enjoy the use of cashless payments. They're going to get even higher likelihood of getting a loan, even lower interest rate, and even higher amount of loan when they use cashless payments. And we have a second set of proxy for firm quality, which we can uniquely construct from the content of payment data. Here, we are looking at the level and volatility of your payments, with the idea being with a higher payment level and a less volatile payment is suggestive of a healthier and the better business model, and that will be eventually translated into better financing terms. Indeed, those interaction terms shows that for those firms with a higher level of cashless payments or a lower volatility of cashless payments, those firms will be more likely to get along and they're going to enjoy a lower interest rate. And those firms with lower volatility, they will be more likely to get along and they're going to enjoy lower interest rates. So that happens again at both extensor margin and intensor margin. Finally, we show that consistent with hypothesis 3, a higher share of cashless payments is associated with a lower default, again, suggestive of the risk-reducing effect. And it's even broader. It's externally valid to other type of alternative data on top of cashless payments. The share of revenues from online marketplaces can also negatively predict default. So they both speak to the role of alternative verifiable data in helping lenders to allocate capital more efficiently. Okay, let me summarize. Here we have a paper, both theoretically and empirically, speaking to the idea of fintech lending and cashless payments enjoying a synergy between each other. And that provides a rationale for why they can rise hand in hand, and that further suggests a potential banking model going forward without traditional balance sheets or relationships. It also provides a rationale for data sharing and open banking because, as we show, they can help fintech lenders to level the playing ground with traditional banks. And it does have even broader implications regarding the feedback between the use and production of verifiable data. So that speaks to the idea of, at the macroeconomic level, data can be indeed thought about as a capital good going forward. All right, let me stop here. Thank you so much for listening.
Yeah, so thanks very much for having me discuss the paper. And it's a very interesting paper to read. And yeah, they answer kind of a very interesting research question and also using, a very novel data. Yeah, so let me just first kind of talk about my plan for today because I have more time today, right? So I'll first just summarize the main finding of the paper, and I'll talk about their theoretical framework, the data, and empirical result. And because I have more time today, I'll kind of go through some of their main finding and kind of my comments in more detail. And finally, I'll talk a little bit more kind of more broader comments I have. Okay, so first, let me just talk about just like the overall kind of the research question of this paper. So this paper tried to kind of understand how the use of outside information affect lending outcomes. So basically there are two kind of mechanisms. So like one is more information can help better firms. So because they can have more verifiable payment records and they can get a better loan terms. And the other one will be a risk reducing effect because this information can help all firms. So that will help like all the firms to get the better terms and also the lenders. And this paper kind of focus on the role of cashless payment. So basically they try to argue that this cashless payment will leave a record. So basically leave a data and which can help to reveal the quality of firms. So these can help lenders to do a more efficient screening. So because they have more information. And it also leads to a strategic demand side responses. So basically like firms will more likely to adapt cashless payment because that can kind of signal lenders they are a better types. So overall, I think this is a very, very interesting research question. So basically, there are lots of interesting about fintech lending, right? So people are also interested about data sharing. So this paper kind of combine, two very interesting research questions together and help us to understand how data sharing can affect fintech lending. And especially the paper focus on India. So there's also kind of additional kind of implication for how the fintech lending can affect developing countries. Also, what I like about is they have theoretical framework and they have kind of good theoretical prediction. And then they also kind of, for each prediction, they have empirical findings for the prediction. So it's kind of like the theoretical empirical result tie closely together. Okay. So let me kind of briefly summarize their main findings. So basically, they find that outside verifiable information significantly affect lending outcomes. So basically, they show a higher share of cashless payment, improve lending outcome by having a higher chance of loan approval, higher loan amount, and also lower interest rate. And I think they first kind of show more like result, more like correlational, but then they also kind of show a more causal one using an IV driven by the Indian demonetization in 2016. And then they also show cashless payment benefit all firms. So these they call risk reducing effect. And then they also show higher quality firm benefit more from cashless payment. So this is consistent with the information revealing effect. And finally, they also show firm with more cashless payment is less likely to default. Okay, so let me first talk about their theoretical framework. So basically, the theoretical framework is very clear. So basically, they kind of just, there's a risk neutral firm and a risk averse lenders. Okay, and firms have their own private type, and their product quality follows the private type. Okay, and then the lenders do not know the private type, but they have prior based on a distribution. Okay, and in the beginning, firms cannot choose whether to use cash or cashless payment. And basically, the cashless payment will generate kind of additional information to the lender that kind of signal their types. So I think the setting is very clear. And also, I think that's kind of the purpose for the theoretical framework, right? But I'm still struggling about kind of in this setting, firms only choose a cashless payment mainly for the lending outcomes. But in reality, we probably think, the lenders, not lender, the firms choose cashless payment mainly for other reasons, like, it's costly to handle cash, or like, tax purpose, as Bernie mentioned, right? So I don't know whether the result would be different if we consider other reasons. Okay, and the main prediction from their theoretical framework basis this equation, which you have already seen before. And so basically, the cashless payment will have two effects. So one is information revealing, and one is risk reducing. So basically, information revealing basically reveal firms type, so that will help better firms. So higher than average firms will enjoy a better price improvement. And there's also risk reducing effect, basically that will reduce the net risk of financing. So all firms will enjoy the price improvement. I think here, this equation might give you an interesting prediction is that higher quality firms are more likely to adapt cashless payment. I think that maybe this is also interesting kind of empirical things to explore, right? Because I think based on this prediction, better quality firms is more likely to adapt because they have a better price improvement, right? So kind of maybe you can think a little bit on this prediction. Okay, so basically their model have four main prediction. Basically, there will be the average price improvement from choosing cashless payment is greater than 0. And more cashless payment, there will be higher chance of loan approval, higher loan amount, and lower interest rate. And this will be larger for higher quality firms. And more cashless payment, the record will be more precise, the signal will be more precise, and there will be less default. And finally, they have a very interesting prediction is that all firms in the equilibrium will optimally adapt cashless payment. And so they kind of say this provide a theoretical framework to understand why the cashless payment become kind of more and more popular. So I think this is a very interesting prediction, but of course, reality, we do not see all the firms adapt cashless payment. Right? So I think it's interesting to think about what is the friction here that prevent all firms adapt cashless payment. Especially, I know that these results just serve as a benchmark, but there might be some, for example, like if I want to invade tax, right? And this might be correlated with my private type, maybe like, lower quality firm is more likely to evade test. So consider this kind of interaction might give you a different result in the equilibrium, right? But I think, but overall, I think the modeling part is pretty clear, right? And the next step they do is to use a very novel data to provide evidence consistent with their model prediction. So I really like the data. The data is from a leading India fintech lender, and then covers about 4 years. So they have kind of all the information from applicants and also kind of the information from credit bureau. So I think the credit bureau data will be the credit bureau data we used to know, right? But I think the most interesting part will be they actually observe the monthly statement from the applicants. And it's a transaction level data. So they can kind of use this transaction data to kind of understand the share of cash and cashless payment, and also kind of whether this payment is information intensive or not. So I think this part is kind of a very unique feature of this data and allow them to understand, answer this interesting research question. So I think their main finding is this table 2 in the paper. So they kind of show higher share of cashless payment is associated with higher loan approval, lower interest rate, and higher loan amount. And here, of course, this is just a correlation, no, but later on they will use the IV to show you a more causal evidence. Right, so I think here you actually group all the, just like firm with 0 share and positive share together. Right, but I think it will be interesting to separate, the 0 share and positive share, because I think if you event a 0 share, that directly give you the risk reducing effect. Right, and the positive share show you like information revealing, right? So I think it will be interesting to think about. So I think here, most of the people probably worried that the share of payment is correlated with unobserved firm quality, which correlated with the loan terms, right? But of course, you already have so many control. Yeah, but one thing I think it will be interesting, but really depends on how many applicants repeatedly in your data, right? But you have a panel data, so you can kind of explore the panel data and control for the firm fixed effect, because I think that will help to alleviate many of the concerns on unobserved firm quality here. And the next step, they kind of break down the cashless payment to information intensive and information light. So the information intensive basically means you can identify the counterparty. Okay, and then they do show that information intensive payment matters more for the long terms. One thing I found a bit puzzling will be why the informational light payment sometimes will give a negative coefficient, right? Because I think that suggests more information actually give you a worse outcome. Yeah, I still don't know why, right? And also I think if the banks actually, lenders actually use this information, the lending outcomes might be depending on who is the counterparty or not, right? So there might be some kind of interesting heterogeneous effect to explore. And also they show that not only the cashless payment, also the the revenue from online marketplace also is also another verifiable information. So here they do find that, okay, higher sales from online marketplace also lead to a better loan terms, right? And so I think for the share of cashless payment, you actually control for the number of payments in total, but here you didn't do so for the, the number of revenue or number of sales here. And here I also noticed the sample size didn't really change, but I remember like not all the firms are third-party merchants. So it's kind of like you're grouping all the 0 and non-zero together, right? So this might actually capture third-party merchants are less risky, right? So maybe it's better just to conditional on the third-party merchants. And they also kind of use the IV to give a more causal result. So I think Yao already explained the mechanism here, right? So so they kind of show the demonetization. If you are if you are banking at a chess bank, you will have a lower share of cashless payment. So this is the first stage here. And then basically the second stage shows you that the higher share of cashless payment lead to a higher chance of loan approval, right? But I'm just wondering why you didn't event the interest rate and loan amount here, right? And also I think it's really nice to see the first stage result over time, because that kind of show this is driven by demonetization. Right? So if you also show the reduced loan over time, I think that would be clear that, you know, this effect is indeed driven by the demonetization. And also because I think you have before and after treatment and control group, right? So it's also, you can consider to do a DID versions of IV with IV, right? And maybe also use other banks falsification tests, right? Because I think here it's consistent with your hypothesis, but I think, you know, there are so many things going on in the demonetization, right? So I'm just thinking if there's more evidence to show that, you know, this is indeed the mechanism you are talking about will be good. And the other thing is, if you look at the magnitude of the loan approval, it's actually much larger than your OLS estimate. And, you know, when I look at the paper, I was thinking that you will overestimate your result because, you know, maybe like higher quality firm, unobservably higher quality firm will adapt cashless payment, and that correlated with the better firm. But here you actually find your IV estimate is actually much larger than your OLS estimate, right? So it's something to think about, or maybe can have some explanation. And they also showed that higher, better quality firms will enjoy a better price improvement. So they kind of approximate the firm quality using your average monthly revenue and also your weekly revenue volatility. Okay, so so indeed they find that better quality firms will benefit more from cashless payment. Okay, but here if you look at the column 4, so although it's marginally significant, but a higher volatility actually correlate with a lower interest rate. So that made me wonder, just like whether the you know, revenue volatility is a good measure of firms' qualities or not, right? Because higher volatility may suggest other things and instead of quality. Okay, and then my table here. So basically you also show that more verifiable information is correlate with less default, right? And then indeed we see that a higher share of cashless payment correlate with less default, and also higher share of revenue from online marketplaces correlate with lower defaults. So one thing I thought about would be you can try to control for interest rate and loan amount here, because in the previous result, you show that cashless payment will affect the loan outcome, right? But that the loan terms also correlate with the probability of default, right? Especially if it's, you know, if you have a lower interest rate, you are less likely to default, right? So this omitted variable actually work, you know, in the same way as your result, right? So maybe you can think about to control for the loan terms here, right? And also kind of, you can also think about to control for your proxy for loan quality. This is also correct. So this is kind of, you know, here is a more omitted variable which you can control for, right? So I think this is something to think about, but I think the result probably won't change, right? But just kind of some additional robustness check. Okay, so I actually went a little bit faster than I thought, but let me just quickly kind of conclude. This is just more kind of my broader comments for the paper, right? So I think it's the result is super interesting, right? But when I read the paper, I keep wondering, like, do banks really use cashless payment? Because I don't know the India market well, but this is just like something new to me. But I'm quite surprised that, you know, like a lender will actually check the share of cashless payment here, right? So it would be nice to provide more institutional details, right? Like how does the lender actually process the statement and the payment record? So do they really care? Do they really care the cashless payment, or is actually some other verifiable information that correlates with the use of cashless payment, right? Because you will still find the same result, right? But maybe they cares about other things, right? And maybe there's, if there's some news or like, the discussion between the firms saying like, oh, we need to adapt more cashless payment to enjoy the better loans or something, that would be nice, right? And maybe you can also show more kind of heterogeneous effect to strengthen this mechanism, like, identity of counterparty, type of transactions or transaction amounts or something to show that the lenders actually use this information. And also kind of if you can show the, the shared zero and non-zero part, I think that can help to separate the information revealing and risk reducing effect. Yeah, and other things about kind of your result will be, because I noticed in this version, you actually control for credit score group fixed effect here, but in the previous result, you didn't. Yeah, and yeah, just wondering kind of whether the result, if you control for more flexible kind of function of credit score, whether the result will change or not, right? Because here, yeah, I'm still worried about there's unobserved quality, which is correlated with the cashless payment, and that drives your result, right? So especially credit score, I think is a very important characteristic to control. And also, I think you can maybe you can try to control on the applicant level instead of applicant month level, unless you really have a. Yeah, I don't think the result will change much unless you really have many repeated applicants here, right? But I think here we probably worry more about the, within applicant correlations. Right, and then finally, I think if you can provide some evidence on demand side strategic responses, like strategic adaptations or something, I think that will kind of strengthen your model a bit, right? Because you also talk about these demand side responses. Yeah, so it would be nice if you have some evidence for this, right? But yeah, overall, I think it's a very interesting paper and with very nice theoretical model and result. So everyone is interested in this topic, I encourage you to read the paper. Yeah, and thanks so much for having me. And let me just stop my discussion here.
Thank you very much, Tiffany, and for your excellent discussion. And Yao, maybe you should respond to Tiffany's discussion first. Then we have more questions. Thank you.
Sure. I just want to say thank you so much, Tiffany, for this super insightful and detailed discussion. It's almost like a full referee report. Thank you again. Yeah, there are a lot of things we can potentially do as you suggested. We'll definitely try. And some of those suggestions we have already tried in the index and in the appendix. Some of them we have tried, but we are still subject to some data limitation. For example, as you suggested, we could potentially include a borrower fixed effect, but unfortunately, we just don't have many repeated borrowers in the sample. And we don't have so many observations before the demonetization. So that's also the reason why we didn't use a diff in diff strategy, but we look at demonetization as an IV. But again, so there are a lot of things we can potentially try. At the broader level, I think two things maybe I can talk about a little bit. One thing is, as you said, this is the benchmark result, but as I also answered Bernie earlier, our results are indeed robust to a context in which some people use cashless payments, some people still stay with cash. So as you said, in reality, there are a lot of different reasons, right, which may drive this choice. And also there is a much granular dimension there, right? It's not just about cash versus cashless. There are a lot of different payment technologies, right? You can choose amount. So the key economic thing we want to highlight here is it's really about how verifiable the data is, even if you use cash. So because in this context, right, it's not pure cash. It's still like cash transaction into or out of a bank account. So there's still some information content there. because after all, those cash transactions will show up in your bank statement. So that is something we think might potentially reconcile the idea of information light payments can sometimes hurt you, right? So this is something you find puzzling. We also find that initially puzzling, but at the end of the day, we thought maybe it's indeed something consistent with the economic message, because even, I mean, cash is the benchmark in our model, so there's nothing there, completely nothing. But in reality, even if you use cash, it can still convey something, versus if you use some pretty light information, so that might even hurt you. So that's like, I mean, something we think is economically consistent with the model. And also, I guess that speaks to the idea that we kind of intentionally avoid looking at the detailed payment context, like, because there's some other papers in the literature talking about, for example, if people buy more video games, or they subscribe a lot of magazines, looking at sports, or simply entertainment. So those kind of things can predict a higher likelihood of default. So a lot of things we can look at, right? So by reading the detailed content, but we kind of, I mean, we purposefully not looking at that because we want to focus on something we highlight in the model, verifiability. So that's really about the technology. So that's really about how much information you can trust from that data. In other words, how rich that information is, even if you forget about the detail, the content of that. So that's something we really want to highlight economically. But you're fully right. I agree. So if you look at the detailed data, or you can actually talk to the lender, right? You ask them, okay, so what kind of information you most focus on? But in some sense, we're not that interested in their business model. We're interested in an economic interpretation of what they do. So we don't really want to unpack their black box. So it's not like we want to know everything what they do, but we want to give an economic interpretation of what they do. So yeah, that's probably something we want to highlight. But again, thank you so much for this discussion. This is super helpful.
Okay, thank you. There was a question online. Christine, do you want to ask a question directly about data privacy? There was one question online, so, or maybe we'll have more questions, you know, if we can ask you directly. Thank you.
Sure, yeah, please.
If not, can I ask one question? So let me start off, kick off the discussions. My question mainly for policy implications. Things like India, China, Kenya, all those developing countries, they're facing so-called financial inclusion, right? They need to access finance. So since the big countries, they're facing this kind of financial inclusion, you know, this kind of perspective. And can you provide some policy implication in terms of regional variation? Think about remote area, think about rural area. Can you do this kind of a regional variation to identify, also echo the recent paper by Sumit about road and loans? If more infrastructure to the you know, modern financial institutions, you might get better loans. So again, so this is more like policy implications. You can do more regional variation because India is big. Okay, it's number one. Yeah. Number two, I think it's also very interesting to, you know, as Tiffany just mentioned, you can provide a little bit more about the lending process would be great, because I understand you have this kind of causal evidence from this, you know, this kind of policy shot. But you also have very nice setting in terms of rejection and approval, right? You can think about very similar people, like you and me, we're both from Peking University. You do excellent, but I do relatively poor. So we can run this kind of selection in terms of selection, first stage of selections, then use a second stage using a hazard rate to echo all this kind of you know, this kind of how to say, rejection, approval, this kind of selection process as the first stage, and second stage you follow normal two-stage square to identify this causal relationship. But bottom line, also as Tiffany finally try to point out, so-called strategic adoptions. Because if I'm lenders, we all know Lucas' critiques. If I do more online payment, cashless payments, I might get loans. So as you say, you have a new borrower and repeat borrower. At least to show some robustness will be great. Finally, if you have a long-term consequence, also will be great to make a paper much more comprehensive. Thank you.
Yeah, thank you, Yi, for that great question. Yeah, I fully agree that financial inclusion is something important. And I think our paper does have implications on that, because when you think about the risk reducing effect, it does suggest that for people who don't have a great credit score, for people who don't have a long enough credit history, they may potentially leverage on their payment data, right? Because still for people, because I remember when I first arrived in the US, I couldn't apply for credit scores. Sorry, I couldn't apply for a credit card because I didn't have credit scores. But it doesn't necessarily mean that I'm bad, right? It doesn't necessarily mean that I couldn't pay my loan back. So I guess that's indeed, I mean, the benefit of potentially using cashless payments in helping with financial inclusion. So we didn't directly test for that. I guess that's also related to the second question, and also the question Tiffany mentioned in terms of the adoption of cashless payments and eventually the endogenous choice, right, between fintech lender and maybe traditional banks. Because unfortunately, we don't have many repeated borrowers in our sample. So it's a 4-year sample, but still it's not a super long sample. And we would love to explore in those directions more. So if we can get better data in the future, but I totally agree that those are important implications to think about.
By the way, Yao, can you see the chat box? Because some of the people who raise question, they are not.
Oh, yes.
They do not enter as panelists. So would you mind to take a look at the questions, for example, the data sharing, and help us?
Yeah, sure. Yes, I think there are 2 questions in the Q&A box. So yes, the first one, the first one asks, are we assuming that cashless payment means more intensive data? Is it always the case? Yes, it's a good question. It's not always the case, as we show. And when we look at information intensive versus information light ones, even when you think about cash, right, in our context, it might be more informative than some of those information light payments. Yeah, I mean, again, so economically, it's not just about cash versus cashless physically, but it's more about how verifiable the data are eventually. And there's a second question by Christine Limawan, which asks, how should the data sharing landscape be structured in the industry to amplify the impact of using cashless payment data in credit underwriting while keeping data privacy protection in place? In most cases, the platforms that own those alternative data are not willing to share their data to other providers. Indeed, yeah, I agree. I mean, I think this is indeed related to the broader idea of open banking. That's the reason why in many European countries right now, they try to promote policies to encourage or even force banks, traditional banks, and platforms who own data. Yeah, I guess this is probably also related to the ownership of data, right? So whether it's like the platforms owning the data, or borrowers, or those and consumers eventually own the data. I mean, that's also important depending on the detailed legal context. But you're right, I agree. So there are a lot of things to be considered here regarding how we can possibly encourage people to share their data. In our model, so we assume that there is a commitment, which means that if you use cashless payments, at the end of the day, because fintech lenders, typically they have a better capacity in getting access to such data, and they have a better capacity in using that data. But still, there might be some data which are hidden there. You have to explicitly say yes to transfer this data. Now, I mean, it's still consistent in our model with the information unraveling effect, because if you own the data, right, if everybody owns our own data, now if better people like Tiffany, E, and Bernie, share their data, that's going to make me more tempted to share my data, because if I don't share my data, right, so the lender will look me as a bad guy, and the lender will think, okay, so maybe I'm hidden something. So, and that's also an economic mechanism we want to highlight here, which can further promote data sharing, even if there's no policy in place. But I agree that in reality, so when we think about the currency policies in the Europe, which promotes open banking and data sharing, they can generally help.
About Christian's question, I think some public-private partnership effort these efforts are coming together. We are trying to think about some data utility center, but how actually to construct the architectures and the legal requirements and so on is still unknown. But I know that because the G20 is in Indonesia and so on and so forth, so there are people putting their mind together to come up with an architecture to see if they can solve the problem. Let me see if I can understand Yao's thing. Essentially, I have cash that I can have my book, but if cashless payment is there, my book is a lot cleaner, the information is a lot more reliable. So there's a substitution of using verifiable information for me to show that I'm not a lemon, and therefore there's some self-selection that people who need credit will jump the gun. They will jump and show, and then they will get their credit. And then because more and more people are showing their book, so those that do not show, they may suffer from an externality, because if my competitors get good credit, you don't, then it will be very challenging. So the question is that at the beginning, when I looked at your thing, I worry about, do we know the how wide the technology? But thinking in the way I just described, I don't even need that. I really just need to know the ability to repay. That's all.
I agree. Yeah.
As that go more and more, then there will be a forced revelation, assuming that if both you and I are a finance constraint, but now I relax my finance constraint, and we are competitors, you're going to lose. So in a way, it's forcing everyone to jump into to get into the territory of more information revelation. I think that is the interesting thing to show.
I agree. Yeah, I'm fully with you. I mean, at the end of the day, right, it's all about to show people you're good, right? You can repay your loan. I think what we highlight in this paper is better technology, or more verifiable technology can help you do that better. That's indeed something.
It's like you're using cashless payment be your neutral, credible auditor.
Yeah, in some sense, exactly. Because I mean, at the end of the day, right, you have to make sure it's not cheap talk, right? If you simply tell your lender, okay, I'm good, maybe your lender will never believe you, right? If you just show them cash, right? But if you show them more, right? If you show them, okay, I'm using a lot of internet payments, I can show you where the money goes, where the money comes from, and I can show you, I mean, those richer information, so they can make sure, so they feel more comfortable. Yeah.
I wonder if you can. I think assuming that we know that technology is a lot of assumption. I wonder if you can redo your thing without that assumption and still get the same result. I think you can.
With could you say it again? With
you have your tau y and your tau x.
Tau y and tau x.
Tau y is technology. That is really, I mean, that is really, you know, the world. The parameters of the world. Tau x is, you know, the parameters to review the world. That if you know the world, I mean, there's a lot of assumptions you make. And if you can do it without your assumption, it will at least it will make someone like me feel a lot better.
Yeah, I agree. That's something we can potentially consider. Yeah, but yeah, I think we're on the same page, right? It's like, I mean, you know something about the world and you know something about the technology. In reality, it's the combination of those. Yeah.
Can I ask a question here?
Yeah, please.
So I've been wondering, you know, how should I think about the difference between traditional banking and fintech lending in this setup? So to me, the basic mechanism you highlight in your model, especially the value of verifiable data, also applies to basically traditional banking. And the only thing that is different is probably when we think about traditional banking, information just stays within, the bank, stays with the specific care of the lender.
Exactly.
And now the fintech can use, information from everywhere. If information is publicly available. So then the question is, to what extent, probably it's related to one of the questions you guys were discussing earlier, to what extent the information is accessible to lenders, regardless of being a fintech lender or traditional banker. And then I think what really matters is to what extent this information is really profitable. For instance, if you think about the small consumers, their information probably is not that valuable. But if you think about Apple, how Apple is doing business with its partners, then I don't think Apple is really willing to share its information with outsiders, right? Because everybody can take advantage of that relationship, Apple's relationship with its business partners. So that goes back to Bernie's very early question. Say that if you think about adoption cost, the adoption cost is really not about cost of adopting cashless payment. Instead, it's the cost of revealing information to the outsiders. Then you may think about this cost is increasing in firm productivity or firm size or firm profitability. And then in the end of the selection is going to tell you, well, only those small guys will be staying with fintech lenders because only small guys are willing to reveal information to the outsiders. So in the end of the day, if you bring in this mechanism, bring in traditional bankers, then what is the future of fintech lender, right? I agree with you, maybe all small borrowers in the end will be adopting, cashless payment or willing to revealing information to the outsiders. But what about those big guys? Is that true? The big guys in the end will be also in the game, or they will choose to stay outside the game. So yeah, of course it goes beyond the scope of the paper, but I'm curious to hear your thoughts.
Yeah, I like that. Yeah, I guess I should admit this is not a paper about Apple, about Microsoft, those really biggest guys, right? Because those guys, they have access to an even larger credit market, like they can issue corporate bonds, right? They even don't have to go to a bank. But I'm fully with you that there could be some interesting correlation between credit risks and adoption costs. So that's something might potentially affect the predictions of this model, because in our model, number one, we consider benchmark in which the adoption cost is 0. So that's the simplest benchmark. And then we can consider benchmark in which the adoption cost, it could be anything, right? It could be privacy. It could be, as you said, right? So the willingness to share information or not. So they all contribute to the net cost and net benefit of adopting cashless payments. But then, as you said, so maybe for some better fund types, because of the business model, they really want to keep their thing as being a secret. So it might actually make their effective adoption cost higher. So yeah, that's plausible, and that's going to generate some pretty interesting interaction, which is not fully captured by our current framework. And also that's the reason I agree. I mean, going back to East Olive's question, maybe yes, our framework current. I mean, it's more suitable to think about small borrowers, to think about financial inclusion, to think about people who don't have access yet to bank finance. Because those people, I mean, they really have a hard time in get access to bank finance. So, and that's indeed the reason why fintech lenders may have some edges in accessing that market. Because that's something we typically talk about in terms of market segmentation. when banks, they target their markets versus fintech lenders, they target their a different market in which people are generally riskier and they lack credit history. And banks kind of forget about them. But then fintech lenders, because of their comparative advantage in accessing information, they can better target that market and to improve financial inclusion. I think that's probably something we are more comfortable talking about. But I could, yeah. Sorry.
Sorry.
I was just saying yes. I like the idea of potentially thinking about large firms and bank-dependent firms, whether in the future fintech may provide something valuable to them. I guess that's a question. I don't have a good answer to, but I'm super interested in that as well.
At the beginning, when I raised the question, I'm thinking about when you choose to use cash payment or move to cashless, there's a cost in adopting cashless.
That's right.
But you adopt it so that you acquire the information, the validate information, so that you can bust up your financial constraint. But those that don't have to worry about it, they don't want to do it. So that's essentially our discussion with Michael and so on about. So the number of players are very varied. It's not just about 2 types. There's 3 types at least. Now, I want to raise a question here. Is it revertible? Like in the financial market, at least later on I can go private. That's reversible. But in this cashless payment thing, is there anything like once I adopt to use cashless payment, is it reversible, or I just close shop and open another shop to reverse? Because after that, I don't want to open. After I become very successful, people all know my name. I don't want to pay tax to the tax collector, so I close my shop, open another store next to me, and I'm still the same Bernie Young face, and people still will come to buy my hamburger.
Yeah, I agree. Yeah, I like that point. So it's like, initially nobody knows you, but now when you use cashless payments, you gain reputation, right. And now people know who you are, they trust you, and then maybe you can switch back to use cash. So yeah, I agree. So that's possible in reality. Yeah. Again, that's probably the reason right now we are looking at the segment in which people simply don't have any reputation, and they really have to use cashless payments to gain the first. They have to get rid of the liquidity trap at the beginning, and Can
I ask a side question? A burning question for me. China is doing more and more cashless payment in the past 5 years. How does it impact on tax collection?
Yeah. I don't have an answer to that, to be honest. But I agree, there could be huge tax implications. Because in India, so the context we focus on, I'm fully with you that a lot of firms, small firms, they simply stick to cash because they can avoid tax better. And even if that's going to give them some disadvantage on the lending market, still the tax benefit is just so huge there, and they never want to switch. There's a huge black economy there, and there's a huge informal economy there. And that's the reason, empirically, we have to control for a lot of things, right? Industry fixed effect and firm age and firm characteristics. So we're saying, okay, so after those controls, we are looking at relatively narrow market segment in which that consideration is probably less important. But I fully with you at the macro level. We're not saying that everybody will adopt cashless payments in the end.
Let me answer Bernie's burning question. Just think about the recently several online sales women, they found, tax evasion. That's exactly because of cashless payment.
I agree. Yeah.
You watch too many Wow Hong.
Yeah. In developed countries, maybe that's of less a concern. But also, in developed countries, maybe, the trade-off could be different as well, right? Because financial inclusion, I guess financial inclusion is still something, right? Even in developed countries, because even in the US, there are a lot of people who don't have credit, super long credit history. And there's some evidence showing that they may also benefit from fintech credit as well. But obviously, I guess if you think about the aggregate impact, I do think that it has the biggest impact in developing countries like China, India, Kenya, in which there's really a huge population of borrowers that doesn't have any access to financial markets, and we're able to buy, but still they buy things, right? Because they have to buy things for their everyday living, and still for those small business owners, they still produce things. So for those guys, probably the welfare implication could be the most significant.
Okay, excellent. Yao and Tiffany and also audience online. And again, Happy New Year. Maybe Bernie, you want to give a final close remark on next?
I think we're already over time, so I just want to say that we all learned a lot from the presentation and the discussions and the conversation. Thank you very much. Thank you, Yuan, for chairing this session so superbly. Our next one is February 9, and Tracy Liu of SEM will talk about efficiency of a dynamic, decentralized two-sided market. And Xiao Lan Qiu of Sida is going to be the discussion. I look forward to seeing you again, and Happy New Year. And by the way, the Lunar New Year is coming too in about 4 weeks. Happy New Year.
Happy New Year, and thank you so much again.